My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today our special guest is zooming in from Los Angeles. Dr. Pranay Parikh is a very experienced, not just medical professional, but a real estate investor and a syndicator. And he's done a lot of deals in the multifamily space. And today we're going to be talking about something a little different, very interesting, and that is real versus fake preferred equity. So Pranay, welcome to the show. Great to have you.
Hey, thanks so much. Appreciate the opportunity to chat.
Yeah. So before we jump into some details about preferred equity, real versus not so real, tell us a little bit about what you guys are investing in, what the portfolio looks like as of the middle of 2025, and how things are going.
Yeah. So all cards on the table. Most of our deals are actually multifamily equity deals where we would be JV equity, right? So we would be the only person in the deal bringing in 90 to 95% of the equity. And that also gives us decision rights. It's kind of like how JP Morgan Chase, a lot of these other larger banks invest, right? Because they don't have boots on the ground everywhere they want to go. And they have a little bit more money than we place, not much, but they just don't have the time and expertise to have people, experts everywhere. So we partner with sponsors and really will kind of really partner with them because we have our own asset management team, because no one's going to care about your money as much as you do, right? Mm-hmm. And that's what we've been doing 3-4 years. We own about 1,500 units across the US, Texas, Florida, New Mexico, across the US, all multifamily apartments. But then more recently, we've been switching to preferred equity, which is kind of a transition we made about last year.
Okay, so let me unpack that for a second just to make sure I understand it. So when you say we, is it you and a few partners, or do you typically raise capital from a lot of limited partners? Do you have a fund? How does you guys bringing the capital to the table usually?
So I'd say a majority of our deals, we have 14, 12 of them are single syndications. So GPLP, where we would bring in, I think our largest had 400 investors in it. Wow. We really try to make it democratic. So we'll have a minimum down to 35,000 and really make it so it's accessible to everyone. As long as they meet the accredited investor, which is a legal requirement in the US, we will accept everyone because we want people to get into this type of investment with steady cash flow and good returns, and not be priced out, which a lot of people are. Minimum is 50, 100, 250. Whenever I talk to a fellow syndicator, first thing they say is you got to raise prices, you got to raise your minimums. But we really want to be accessible to everyone because we think it's a great investment.
So do you guys typically work with medical professionals? Is that kind of
that is correct. Yeah, all three of us founders are physicians, practicing in one way or another. So it's just easy to talk to friends, family, and coworkers. And fortunately, we have a couple thousand actually investors at this point. Wow. We own about $350 million worth of real estate across the US and have placed over 100 million.
Wow, very, very impressive. So things have been a little bit rocky, even with some really good operators over the last few years with everything that's gone on with the value of properties and interest rates and that sort of thing. How has that affected you and your group?
Yeah, I think if anyone tells you that they haven't been affected, they're might not be completely honest. And so we own 26 properties. Either we're maybe a co-GP, so it's only a couple 100,000, or we own the whole thing in a JV or co-GP structure. And so out of those 26, 3 of them have been facing some struggles. So kind of the same as you expect, floating rate debt, some markets being worse than you expected. And so those ones are struggling a little bit. And
well, 3 out of 26 ain't bad these days. That's pretty darn good.
Yeah, you know, it I can tell you those three take up 80% of the work
Of course.
that we do, if not more, right? And but it is what it is, right? It's impossible to really, throw a perfect pitching record, right? Like if in baseball, I know a lot of your audience are Americans. For baseball, you hit a .3, right? 30% at bat, and that's a huge success. That'll get you into the Hall of Fame. So we are a lot higher than 30%, but we know that some are just not going to make it. We're still trying our hardest, and they haven't done poorly by any means. Actually, those deals are outperforming the submarket fast, but there's only so much you can do to escape the submarket. If the submarket, the cap rates are too high, the values have dropped, the rents have dropped, there's a lot of inventory, there's only so much you can do operationally to improve the property.
So, Pranay, we were talking a little bit off camera before we started the recording that you guys are really starting to look at preferred equity as a way of going about it. So, for folks who aren't familiar with that, maybe explain what that means and compare that to what the typical way was that you were participating in deals.
Yeah. So what we'll be talking about is the capital stack. So basically, how does the money stack up in a deal? The easiest way to think about this is your house, right? You put down payment of 20%, that's considered equity, and the bank owns 80% of that house because they give you an 80% loan, right? 80% loan to value. So of the value of the deal, 80% comes from the bank, 20% comes from you, and that number can change a little bit. So in that scenario, 80% from the bank is called debt, 20% is called equity. Now, nice thing about the bank is they get a steady return every month, right? Say 5, 6, 7% these days. Fortunately, my mortgage is at 2.3%. But it's called a coupon. Every month they expect a check in the mail or the direct deposit, right? And if you don't get that, they take the property back, right? So for them, they actually want you to put the largest down payment as possible, right? Because if you stop paying, then right now it means they got 80 cents on the dollar. But say you put a 50% down payment and you stop paying, they just got this deal for 50 cents on the dollar, right? It's to their benefit. And every month it becomes more valuable to them to take it, right? Now, say the property is worth, say you bought it for $1 million, say it's worth $2 million, right? The lender doesn't get any of that increase in value. They're capped. They only get that 6-7%, right? Whatever it is on the day that you got the mortgage, that's what they get for the life of the deal. Right. Now, on the equity side, you have to pay every month to the lender, right? Now, if it's a rental instead of the house you live in, whatever rent you get after you pay your debt, after you pay your expenses, that's money you get to keep, right? And if you sell the property in a couple of years and there's a big increase in value, you get to keep all of that, right? Minus whatever you pay in taxes. So that's really the benefit of the equity. Really uncapped upside is what you call it in the industry. And that's what, we all chase after. We want that property that just goes to the moon and is worth 2-3x in a couple of years, right? Now, preferred equity is somewhere in the middle of that, right? It gets steady monthly payments, and it's because it's behind. So it's secondary, also called junior, because it's behind debt to be paid. So debt gets paid
behind the mortgage. Yep.
Yeah, behind the mortgage, it gets paid in full. Then preferred equity gets, because that's a secondary position. It's a little riskier, right? That has to be paid first. You get to ask for a higher percentage. So instead of 6 or 7%, you get 8, 9, 10, 12%, right? For the year, paid over monthly. And you sometimes can get piece of the upside as well. And it's all depending on the deal. And the tax, you could also have some tax benefits that I didn't mention. So debt gets taxed as interest income, which is your marginal rate. Equity, because you get depreciation, which I won't go into right now, but basically you get to defer your taxes. Right. Preferred equity can kind of do something similar. Now, you don't get depreciation, you don't create new losses like you can on equity, but if you have a lot of losses that you haven't used, like most of us do, you get to use that. So it's kind of the best of both worlds. You do get a capped upside. So even though you can get some of the upside, it's capped at, like a 12, 14, 16%, which shoot, I'd take that any day these days, right? So it's best of both worlds, and it's safe, right? Because you have that cushion, that 20% or 30% of equity, that even if the property, this is happening in one of our deals, the seller is selling, the sponsor who has it is selling it for a small loss, but we're still getting made whole because we have this huge buffer that the property could lose in value, and it still doesn't affect both our initial investment and our returns.
Okay, so you were also telling me that you're starting to see some stuff coming up that people are calling preferred equity, but it really isn't. So maybe tell me a little bit about that.
Yeah, so it's muddying the water, which is making things very difficult. So the rule of thumb I like to see and talk about is like, is this preferred equity on a new deal or is it an old deal? Right. So it's not always true, but just the easiest way. So what I'm seeing a lot, and we are doing it too. So I don't think it's anything malicious. I think you just have to be clear on what it's doing. So what we're saying is on our old deals, which as I mentioned, only 3 out of 26, if people, the original investors or new investors are putting money in, we will give them a preferred spot in the capital stack.
So new capital coming into an old deal.
New capital coming into an old deal. So
Okay.
Instead of the original investors, which we are as well, the new investors get paid back first for taking the risk on this old deal. Now,
Okay, so they get to jump to the front of the line
exactly
behind the bank, behind the
behind the
mortgage.
bank. Yeah.
Okay.
Yeah.
Yep.
So a lot of people are creating these preferred equity funds that just all they do is pump money back into their old deals because a lot of the old deals are struggling. They're on floating rate debt and they got to buy new interest rates, interest rate caps. They got to, they're having issues with operations. So that in general is a lot riskier because if you are having to inject new capital into an old deal, most likely that property is underwater, meaning it's worth less than the mortgage on it. Because if it was worth more, significantly more, you would probably just sell it. Even if it was worth like, let's say 50 cents on the dollar, you on top of the mortgage, you might even still sell it, right? Because a negative 50%, getting half your money back now as opposed to a potential 100% in the future with all this risk, right? So you expect that property to be really 100% LTV, 120% LTV, meaning the loan is worth 120% of the value of the deal. So then basically equity is all wiped out. So the chance of you getting repaid there is pretty slim. It's almost like a lottery ticket. So maybe if you really believe in the deal, you really believe in where we are in the market, but there's a lot of ifs. Now, as opposed to a new deal, right? You can make sure that your last dollar is 70% LTV, 75%, so that you have that 25% buffer. And remember that all property values have been reset basically for the past 2-3 years. So now if you're getting 75% of the current value, that's probably like 50% of the, or 40% of the value in 2022 when everything was like $17 million. Yeah.
Yeah. Okay, very good. So yeah, it really depends on which kind of deal you're getting into. So bottom line, if it's a new capital into an old deal, basically the original investors, if I understood you correctly, are kind of out of luck because these new investors, preferred equity, get bumped to the front of the line. So if and when the property does sell, bank gets paid first always. They get paid second, and then whatever's left over gets divvied up amongst all of those original investors. I can imagine there's a bit of an uproar about that. What kind of
I mean, it's typically like a capital call, right? So where the hope is that if you inject 10 to 20% of new capital, say it's a $10 million equity check, say $30 million deal, originally a $10 million check. If you put in maybe 1 to 2 more million, that'll get you through the next couple of years. And having $1 to $2 million in front of you won't kill a deal. Now, if the deal is already sucking, or you have to put in 3, 4, 5 million, and the question is, right, how long is this pain gonna last? I think all of us would agree with the current volatile political market, to say the least, the pain might last longer. Because before it was survive till
3.5
25.
years. Is that what we're
Yeah.
thinking?
Survive till 25, right? Now it's
Yeah.
survive till, I don't know, 28.
Yeah. Yeah. It's very interesting times. That's for sure. So, Pranay, when it comes to raising capital in today's environment, I mean, you guys have been rocking and rolling. I believe you said you've got over 1,000 limited partners kind of in your stable, folks that have invested with you. Um, what are you seeing these days for raising capital and bringing new investors on board?
Oh, it is hard. It is
Yeah,
the hardest it's ever been. And which is unfortunate, right? Because it is the most opportune time, right?
yeah,
Because
yeah.
we're probably close, I would say the bottom of the U. I don't know if it's going to go down a little bit lower or it's going to go back up, but we're somewhere in the bottom of the U, right?
Mhm.
And so values have gone down. Interest rates are probably going to go down a little bit more or stay the same, right? So then the market has really assimilated that information. So it's the best time. While, 21, early 22 was probably the easiest time to raise capital, which it was the worst. So it goes, in cyclical times. But if you can raise deals, what we're looking for is we're looking at deals. Our largest raise was $28 million of capital placed in a single deal.
Wow.
We're looking at deals of 5 million,
Mhm.
8 million. So a third, a quarter of what we used to do. But I think that's what the appetite is. And we're looking for steady cash flow as opposed to, equity deals, 2-3% a year, people are happy with, but now people want 6-7-8% because you can get so much safer money elsewhere.
Right. No, that makes sense. What are your goals for the next, where you see you guys and Ascent Equity going over the next 12 months or so?
I think we'd like to start seeing more preferred equity deals. We have a current deal
For new deals.
for new deals. Yeah.
Yeah, yeah,
So probably 2 to 3 deals in the next 12 months. We have a hotel deal that we're looking at that's very interesting, like
interesting.
70% LTV, our last dollar, and then like a 8% per year, and then a 4% at the end.
Mhm.
So 12 in total. So that's the kind of stuff we're looking at, double-digit returns, some accrued, some current pay, and then a low LTV.
Very good. Dr. Pranay, this has been very, very interesting. Thank you for unpacking and explaining preferred equity. I think you did a fantastic job. If a dunderhead like me can understand it, I think everybody else can very, very easily. So you explained it very, very nicely. And I'm sure there's going to be some folks listening or watching this who would like to connect with you. And if so, where should they go?
Yeah, our website is the easiest place, ascentequitygroup.com. You could click on join our email list, let them know that you heard us on the podcast. I'm happy to jump on the phone if anyone wants to talk about deals, preferred equity. Yeah, just an open book.
Awesome. Very good. Well, thank you very much for being on the show.
Thanks. Bye.
And everybody, thanks for tuning in, and we will see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.